Good evening to all of you. When I walked into this room, I saw this backdrop which was created for the post-budget analysis. And I found a lot of complex figures on the backdrop. And I was reminded of a story of a little boy in school who was given a puzzle. And the teacher asked him to put the pieces of the puzzle together. And this boy struggled and struggled and he couldn't put it together. So the teacher told him, now I'm going to give you a picture. Just turn all those pieces and now put the puzzle together. And when he turned the pieces, he could do it very easily. He saw the picture and he did the puzzle very easily. And guess who the picture was about? It was P. Chidambaram. So today we're going to basically see how Chidambaram has solved the fiscal puzzle. There are a lot of things he has done in this budget. The few things I would like to say at the outset, just as, because we have a big crowd of people who may be in touch with what happens to fiscal policy. The budget is part of what the finance ministry does and what you basically have from the RBI's monetary policy. So budget is basically part of fiscal policy. And today we're going to talk more of fiscal policy rather than monetary policy. There will be some terminologies which you will hear in this presentation, which I'll try to simplify. Please pay good attention at least to the busy slides, because once you understand some of those terms, it becomes very easy to understand what has happened in this budget. So to start with, I think this budget has been a budget which has put India on the path of fiscal consolidation. As you are all aware, there is clearly a threat to India's sovereign rating, and therefore the finance minister was very keen to make sure that the rating agencies don't downgrade India. And if you look at most of the economic estimates before the budget, most of them expected that the fiscal 2013 fiscal deficit would be in the region of around 5.7 to 5.8% of GDP. And the finance minister finally achieved 5.2%. So we're going to basically find out first how he has achieved it and how he's projecting for next year a fiscal deficit target of around 4.8%. Whenever we look at the budget, the first thing we look at is the budget credible? Is it realistic? What are the assumptions that the finance minister has used in the budget? And the top line number of growth is extremely important. This budget assumes a nominal GDP growth rate of around 13.4%. Now, this basically talks about a real GDP growth rate of around 6 to 6.5% and an inflation of around close to 7%. So broadly, I would say we are in line for what could happen in fiscal 2014. So the top line assumptions seem to be more or less in line with what we expect. The second is this roadmap which he has outlined. He is expecting that by 2016, we'll bring down fiscal deficit to 3.6% of GDP. Now, is that a realistic target? And is a 4.8% number which he's targeting for the next fiscal year, is it realistic? And we'll come to numbers on that. Clearly, the intended target has been to revive investments, but my view is that much more has to be done outside the budget policy for investments, but we'll see what he has done in terms of investment policy. As far as inflation is concerned, we all know it's clearly an issue and a concern. So he has, by and large, kept indirect tax rates unchanged, which is positive for inflation. He has given some benefits for capital markets in terms of lowering the securities transaction tax, given easier access to foreign investors, and tried to get more retail participation into equities. And in terms of subsidy, he's now moved on the path of direct transfer of benefits to the deserving population, and I'll come to that slide in a moment. The reform calendar, which we're all expecting, which is the goods and services tax and the DTC, clearly, this is something which we long expected. All that was mentioned is that they will be tabling these bills shortly. So nothing very specific mentioned. I think some of the key challenges which spooked the bond markets was that the borrowing program was much more than what the market expected. And that's the reason why you saw the bond yields actually moving up. And I'll come to a moment as to why that happened. Surcharge has been increased on corporates, which has an impact of around 2% on EPS. So if you're projecting something like 12% growth next year in terms of earnings, it would be in the region of around 10%. And there are a lot of non-recurring sources of income, which include divestments, spectrum, service tax amnesty, PSU dividends, etc. So let's go into the deep dive into the actual numbers now. And this is an extremely busy slide. I hope you can see it at the back. If you look at the budget, there are two components of the budget. The first component is basically the revenue, the total receipts that the government gets, both in terms of revenue receipts and capital receipts. Revenue receipts are composed of tax revenues, which is your income tax, your service tax, your customs duty, excise duty, all come as part of tax revenues. And the non-tax revenues have to do with items like, for example, your dividends from public sector companies. It includes your telecom spectrum auctions, etc. This component largely is what is funded, what is required for funding the fiscal deficit, which is largely the borrowings. And the second component of the budget is basically the expenditure. So this is what you receive and this is what you spend. There are two components of expenditure, which is non-planned expenditure and planned expenditure. And just broad thumb rules, non-planned expenditure is generally used for productive purposes. The planned expenditure is used for productive purposes. Non-planned expenditure includes items like the interest cost, the subsidies, which are not really productive, but they form a big component of the overall expenditure spend. And the planned expenditure is basically meant for growth. And based on the difference between the receipts and the expenditure, you get what is the fiscal deficit. So if you look at fiscal 2013, these are the budgeted estimates of the finance minister when he announced the budget last year, and these are the revised estimates. And you will see that as far as revenue receipts are concerned, it fell significantly short of what was projected last year. So he projected a very large number, and what he achieved was, significantly lower than what was projected. Then how did he manage to bring the fiscal deficit down to 5.2% of GDP? The key here has been the planned expenditure. Last year, he expended the planned expenditure to move up by almost 1 lakh crores. And what he finally achieved was 4,29,000 crores. So he cut planned expenditure to the bone. Planned expenditure grew by just 0.6%. And this is the reason we have been able to achieve a 5.2% of GDP as the fiscal deficit for 2009. Now, planned expenditure cutting is purely bad for growth. And therefore, if this had to continue, it would have been a significant problem for a lot of companies in the Indian economy. So the market was actually waiting to see how would we achieving this 4.8% number which has been committing. And if it's going to come from a cut in planned expenditure, then there's trouble on the street. The good news is that for the next year, he is expecting the planned expenditure to move up by almost 29%. So 29% is what he's projecting for planned expenditure. Now this 29% has to be viewed with the fact that the fiscal 2013 itself has been weak. So we're moving off a low base. So he hasn't grown planned expenditure in 2013. In an election year, we expect that he will meet these numbers of 29%. Now, such a big jump of 29% in planned expenditure, how is it likely to be funded? Because non-planned expenditure is not growing much. It's just growing by about 11%. So planned expenditure growing by 29%, how is it going to be funded? And the funding is basically from the revenue receipts. You will see that in case of tax revenues, he has projected about 19% coming from tax revenues. Now, part of this 19% is coming from the fact that 13.4% is a revenue growth assumption because of nominal GDP growth rate. So the balance has to come from other items like your surcharge, which he has imposed on the corporate tax structure. So this seems to be something which is quite reasonable. There's a big jump in non-tax revenues. And this is because he's expecting some amount of proceeds coming from the telecom licenses, telecom charges. And I'll come to that in a moment, how much he's expecting there. As far as the planned expenditure is concerned, like I mentioned, 29%. We'll come to the components. Interest expenditure and subsidy is something which he can't play around with. They are sticky items, so they will remain pretty high. And the only way he'll have to fund this 29% is by looking at growth in basically revenue expenditure. So for the whole year, he's expecting the fiscal deficit of GDP to move down from 5.2% to 4.8%. And this number of fiscal deficit, which is normally projected, is the borrowing that the government needs to do. So whatever the government spends in excess of expenditure, they have to borrow to meet the numbers. If you look at the new revised fiscal consolidation roadmap, we're looking at the fiscal deficit at the center moving down from 5.2% to 3.6% by fiscal 2016. And the revenue deficit, which is now at 3.9%, revenue deficit is only the revenue items which is being considered. That is looking at 3.9% going down to 2% by 2016. So this is the kind of fiscal roadmap, and given what he has achieved in fiscal 2013, it clearly makes us believe that these numbers are also possible based on some of the measures they are doing in terms of direct benefits transfer. If you look at the market borrowings, this is where the bond market was actually spooked. If you look at the gross market borrowings for 2013, it was 5,60,000 crores. And the finance minister said that he'll be looking at gross market borrowing of 6,29,000 crores. Now, this is not what the bond market expected. Bond market expected that this would be relatively, flat, as you can see what, has been achieved in the previous years. But the net market borrowing has more or less remained the same. So what the finance minister has done is that he has moved some of the short-term borrowings to the longer end of the bond market. So that's the reason you're seeing a significant amount of increase in gross market borrowing, which means more supply of, government securities in the market, which will have an impact on yields. And that's the reason you saw the 10-year, bond yields moving up by 10 basis points in the last, few days. Now, if you look at our fiscal deficit, these are the two components of deficit. Whenever you look at deficit, which has been mentioned in this budget, it's the center's deficit. In addition to the center's deficit, you have also a state deficit. So the red line is the state deficit and the gray line is the center deficit. So if you combine both, state deficits are in the region of around 2.5% of GDP. And if you combine both about 5.2 and 2.5, we're almost at about 7.7 or close to 8% of GDP as the fiscal deficit. So our fiscal deficit is not 5.2, but it's in the region of around 8%. And you can see that our tax collections as a percentage of GDP had shot up to around 12%, but since then it has actually moved down. And the finance minister in his budget speech mentioned that he would like to see this actually going back to the peak. And that's the reason he has imposed some of the new taxes.